My name is John Keene. I am the agency owner of the Keene Agency in Bridgeport, Pennsylvania. I am exclusive with Farmers Insurance. I have 4.5 years with Farmers experience and then another 4 years with a prior carrier, the ones that have the all hands. So I've got about 9 years of insurance experience.
Dave Eglin with First Trust Bank. I run their retail lending division. I've been in mortgage banking since 1985. I've been a FHA DE underwriter since 1996. Any questions related to mortgage banking, mortgages, servicing, stuff like that, I'm usually pretty good to give you some straightforward advice and answers.
Mercury lines of credit.
All that stuff. Yeah.
Got it all. I'm Carolyn Pronte with Caldwell Banker Preferred, located in Conshohocken. Still working my first year under the corporate flag. I did have my own brokerage for 10 years at Harvard Realty in Norristown. I love what I do and passionate about making sure that everybody's educated before they make any mistakes.
Should also say that Carolyn's the president of the Montgomery County Partners, which sponsors this event. That's what we do all year long. I happen to be the vice president, and that's pretty much our function all year round. It's just totally about the education of everything from the beginning to the end of the process as far as purchasing a home.
I used to be the president, too.
He used to be.
Okay.
But then, why everybody's here, literally, if you work in a company where you think this might bring some value to employees, certainly reach out to your HR. We travel. We do road shows. We go on tour. We
bring lunch.
Enjoy it. We do. We bring lunch.
Oh, that's a good idea.
And, if you're the right type of people, we can happy hour it up.
So it's a nice intimate forum, and we thank you guys for coming out. You've taken the best step you could to get more information as you progress on the path to homeownership, and if you're an existing homeowner, to get some more information about potential rental properties. But we all thank you for coming out and taking your time to invest in yourselves to get more information, and that's the key to this is getting as much information as you can to put you in the best decision. To make the best decision, is it now a good time for me to buy and the type of property and so on and so forth. So I know I've spoken to a couple of you guys in some previous workshops. If you have any specific questions, this is real, and John and Carolyn, unless you want to do something a little bit more.
No.
This is just an opportunity for you guys to ask any questions you've ever wanted to know about real estate, insurance, and mortgages. So.
Okay, question about credit score. When you're dealing with a lender, do you look at all three credit reporting companies?
Yes. So that's a standardized, good question. And there was a workshop earlier about that. I know people brought up about, hey, free credit report and Credit Karma has me at 710. And I kind of take that tongue in cheek because their modeling is a lot different than Fair Isaacs, which is what lenders use. All lenders use what's called a tri-merge report. So it's a combination of your personal credit history from TransUnion, Equifax, and Experian. So you're modeled against yourself, but then you're also modeled against your peer demographics. So it will take, there's a component within the analytics that'll take women, say 24 to 35, and their tendencies to pay. I'll tell you, ladies, typically you take identical man and woman, women always have a higher credit score than men. And the reason behind that is women are more financially responsible to pay their bills. So for example, I may be an 824 credit score, and my wife, who has been on 15 years of maternity leave, doesn't have a job, she has an 844 credit score. So women, just in that age group and demographic, they model your tendencies. So all lenders use the same report. Format may be a little bit different, but they all use the middle of three scores. So you take your high score, your low score, and whatever the median score is, that's what all lenders use. Obviously, the lower your credit score, the more challenging it may be to find a loan for you, and the lower or higher interest rate, because your credit risk is a little bit more than if you were a high end in the credit score. So you always want to be the higher end, but again, that's not to say, and your score could be low because you have limited credit experience. A lot of lenders look for 3 trade lines with 2 years of history on each, and that may not be the case, especially if you're starting out. You may not have that, so your score could be low just because you don't have enough credit experience.
And then
So,
there's exceptions to the rule.
sure.
There's always exceptions to every rule, and what might not be a great credit score today doesn't mean that in 6 months you can't be higher than his wife.
Okay, with that being said about the men and the women,
Uh-huh.
the women being always.
Women take their money to pay the
Yeah.
bills. That's
Well, do they?
whatever.
I'm asking for my grandson.
Sure.
Son-in-law and my
Sure.
granddaughter.
Right.
I've been through this process several times.
Sure.
It's changed through the years. So if his credit score is lower than hers, what does the lender base it on? Does it base it on the highest one?
Okay. Yeah, so if you apply by yourself individually, so if your son or your grandson applies just for himself, he's the only one that's applying for credit, so they're just going to look at his score. Now, if your son and let's say his wife applied jointly, and let's say your daughter-in-law is a 700, but your son is a 650, they're always going to, for rate purposes, they're going to take the lower of the two. So, and we have had that happen where, husband and wife, and all of a sudden we run credit and the husband didn't realize the wife didn't pay a couple charge accounts that were just in her name they never knew about. So we've had to, take her off the transaction. So on any transaction, they'll use the lower of the applicant and the co-applicant's score, whichever's lower.
But if somebody's coming off, then their income also can't be used towards the qualifying
That's a good point.
purchase.
But
So-
just learning something what Dave said, because I actually did not realize that. So just here, whether anybody knew the myth, but your insurance company uses credit as a profile. I don't get to see your credit score. I don't know what it is. I don't get to see a financial report like they would. But it does factor into your auto insurance. It does factor into your homeowner's insurance. Knowing that, have the
Credit
woman...
score factors into
Right.
everything.
I might say that in your situation, let's run the homeowner's insurance on the female in the equation. We're always going to add them at the end. It doesn't make a
Right.
difference. But the first quote usually that comes in from an underwritten standpoint is usually the number. You know.
You can use the higher score, whereas the lender.
I don't, yeah, but he just gave me some information I didn't know. So I got a little bit of a tool here. I don't know that because I don't see a score. What it is that for insurance, it's an algorithm. So that comes in along with the house, along with past loss history, along with, if I'm just doing homeowners, there's a whole other algorithm as to cars. Obviously with cars, do you have tickets? Do you have accidents? Things like that. But knowing that, I might suggest, do the homeowner's quote with the female if we're, because they're both going to be on the title. It doesn't make a difference. We're adding it at the end.
Well, and again, homeowners is important to get ahead of the game. A lot of people wait until the 11th hour to get their homeowners. But unlike car insurance, the insurance follows the home. So if somebody used their house as an ATM machine to collect on their homeowner's insurance over the course of 15 years, that house is going to be rated. No matter how good of a credit score you have, no matter what your financing is, you could still run into a problem not having known the history of how that last owner utilized their homeowner's insurance.
Water losses, give you an example. You've had that house, you're buying a new home. Now, hopefully that's all been disclosed in the seller's agreement. But I've had real estate transactions blow up because they found out that there were 2 or 3 water losses within a 5-year period. And it showed up on the home. You're not going to get rated on it as the insured, but the house is going to, it's going to show up on the home.
And you'll pay a higher.
Not necessarily, but it might stop an insurance carrier from saying, okay, we're not going to write that house because we know it's already got problems. Because we don't know what the condition of that house is. And in Pennsylvania, the first 60 days is critical because once you are formally accepted by a homeowner's insurance company, they can't drop you. It's not like auto. If you went out and played bumper cars, your auto insurance company can drop you because of accidents. Your homeowner's company, it doesn't matter how many claims, if you pay your bill, they're going to cover you. That doesn't mean it might not go up, but they're not going to drop your insurance. So, yeah.
All right.
All right, see, we could talk 15 minutes on one question.
Look at that.
Somebody else bring it on. Come on.
Closing costs.
Ooh,
That's
that was
him.
nasty.
I'm free.
That was nasty. Closing cost.
You get the seller to pay them.
Gosh, okay.
Go ahead.
Well, now this is the question and example.
Mhm.
Why is there such variability? The scenario I have, a coworker bought a home.
Mhm.
When she purchased, she paid $10,000. When she refinanced, she paid $3,000.
Okay.
Why is there such a wide
So
variability?
the question was Karen?
Yes.
Karen had a coworker that when she bought the house, her closing costs were, we'll say, $10,000, but when she refinanced, they were only $3,000. So the reason the closing costs are lower on a refinance, the big thing is that you're not going to pay transfer tax. So when you do a resale, and depending on where the property is located, it can be expensive. So in the counties, for example, it's 1% of the sale price. So if it's a $250,000 sale price, she would have had $2,500 in transfer tax that she would have paid when she bought the property. Since you already own the property, that's gone on a refinance. So you don't pay the transfer tax. In Philadelphia, for example, it's a lot higher. It's 4.10%, 2.05 to the buyer, 2.05 to the seller. So the transfer tax goes away in a refinance. So that right off the bat would be one reason why her closing costs were a little bit lower. Now, another reason is you already own the house, so you probably don't need a home inspection. So when she first bought the house, she's probably paying anywhere, Carolyn, you mentioned in your presentation, $500 to $700. So obviously you're not going to get a home inspection or a refinance. So that's another reason why the closing costs would be lower. And again, if it's refinancing with the current lender, a lot of times they'll roll, either or,
They roll it in,
Yeah.
so it's
your escrows,
not a bait and switch, but
it's not necessarily, but your escrows, if you refinance with the same lender, they can move the escrow account from your old loan to your new one. But when you're refinancing, on like a purchase where you're reimbursing the seller for taxes they've already paid, since you own the property right now, you don't have that proration. So they will collect escrows again, but it's maybe just not quite as much as a purchase transaction. And that's probably why you see such a big disparity between when she bought it, what the closing costs were, and then when she went ahead to refinance it.
But if you're buying, would I be correct to say that if you go from one bank to another, that there should not be that much of a difference in closing costs?
Yep. Can I take this one for a second?
Yeah, go ahead.
All right, so when you are,
You
no,
might guess.
basically, when you are encouraged to get more than one lender's opinion of what they can do for you, and then they'll give you a closing disclosure sheet, which is basically what all your fees will be. If one has higher fees, it's all in the fees. Am I right?
Could be, yeah.
So rates, fees, so it should not be a huge difference. So,
Yeah, I mean, it would be counterintuitive for lenders to not try to put, obviously, the best rate and fee structure available, otherwise no one's going to use them. So it would be really unlikely that you went from a lender, this bank A, this bank B, and have a real wide disparity between what their origination charges are and what the next one is. Maybe a couple $100, but a couple $100 could make or break it. A lot of your fees are standardized, again, on a purchase transaction. Transfer tax, that's set by the Commonwealth and the county, and then they get a portion of that, I think. Your title insurance, that's set by the Pennsylvania Department of Insurance. They regulate that. Your home inspectors, they're all around the same price because they want to be competitive. So, again, a lot of the charges, really where you'll see differences are specific, and make sure you're comparing apples to apples. So if you're going to do an FHA loan with lender A and you want to compare the same loan to lender B as opposed, well, I want an FHA loan estimate from you and I want a VA loan estimate from you and I want a conventional PHFA, FHA, HFA preferred risk share closing cost advantage. That will really get just jumbled up. But by and large, you shouldn't have too much of a disparity. So I can just tell you that the bank that maybe I work for is pretty low.
it is. I don't have anything. No, I'm just kidding.
That's it.
But basically, your option to have the seller actually pay your closing costs. FHA allows them to pay up to 6% of your closing costs, conventional up to 3%. And then there's plenty of grants out there where if you can come up with your down money, then you've met part of the requirement. If there's a will, there's a way.
bank versus mortgage company, is there pros and cons when shopping? Just in general?
Well, again, this is an opportunity to get information. You may have some programs and products that a bank offers that a mortgage company doesn't offer, and vice versa. You may have products and programs that a mortgage company offers that a bank doesn't offer. So I know that for a fact. And again, there is advantages and disadvantages of both. Banks that right now participate with the Federal Home Loan Bank of Pittsburgh can offer you the first front door grant program. Then that's a benefit offered only to member banks. So mortgage companies or mortgage brokers don't have that access, but they may have access to other programs, a wider variety of programs than banks. So again, it just pays to shop around and try to find, mortgages are not all one size fit all anymore. So you got to try to find the one that best fits your needs. I hope that answers your question. And if we move in the back. Oh, I'm sorry. Yes.
Yeah.
I knew you wanted to ask a question. You're going to wait till he asks it, and then you're going to.
You're gonna be like, you answered
Okay.
it. We got it.
My question's related to investment property,
Mhm.
and related to mortgages.
Mhm.
I mean, generally speaking, with the regular property, you're talking like 20% down, 80% mortgage. Does that same set of rules kind of apply with investment property, or what's?
The down payment requirement on something that you're buying strictly as an investment property. Yeah, so that, you can do a single family 1-unit purchase with as little as 3% down, 100% if you're VA, but let's say 3% down conventional, 3 to 5% down. The requirements for down payment, your loan to value on an investment property, it's a higher threshold. So and sometimes it depends on the number of units. So for example, if you're going to buy a duplex, the minimum down payment requirement is 20%. Or an 80% loan to value. So if it's a $100,000 sale price, you're going to have to put down $20,000 for that. If you want to buy a multi-unit, which would be, say, 3 up to 4 units, generally then you're going to be putting down anywhere from 25 to 30%. So the higher number of the units, the more down payment is going to be required for an investment property.
You're automatically gonna get a higher rate.
Your interest rate usually is higher. That's a good point, Carolyn. So your interest rate also on an investment property is higher than a primary residence. So keep that in mind too. So it's good that you want to try to buy that because it's one of the strategies you can use to build wealth through real estate, but it's not for everyone. I don't know if you guys own investment properties now or you're just trying to get some information, but there's pros and cons to it. I've owned a lot of real rental properties, and sometimes you get good tenants and sometimes you don't get good tenants. But again, get as much information as you can, find out what your down payment requirements are, what your tax consequences would be, and then, obviously then find a realtor to help you find a good property, and insurance guy to get you insurance on that.
And typically, same thing. Your insurance rates, now depending upon coverage, because that can adjust it.
You need landlord coverage.
Yeah, you need
If
landlord
you don't have
coverage,
landlord
but your
coverage and you try to
coverage is
float
going
it-
to be higher on a rental property than it would be on your primary home, because it's a higher risk. You're not there. You're not there taking care of it. Because we were going to do a presentation in the other one, I do have a one-pager at my table that I'll give you, which was specific to landlord properties, and it'll walk you all the way through it, because the homeowners is relatively simple. We're working to replace the property. That's not always the case in a rental property, because if it's an investment, you may not want to rebuild the property. You may just want to take the cash, the total loss, and walk away from it. So whether you need all of the homeowners types
That's
coverages.
the things you don't talk
Right.
about in front of your mortgage people.
Right. Whether you, well, no, but I mean, if it's replacement cost, then we have to write the policy
Right.
a certain way.
And I was just going to add,
Right.
and maybe you have an adult daughter or son that has good credit scores, and maybe you're going to buy it as a second home or a kiddie condo or something like that. So it doesn't necessarily need to be classified as non-owner occupied. But she's done school and she moves out, then you rent it out. So
But the important thing with landlord policies is, if your tenants are
say
going to
that.
damage your property, 9 out of 10 times, if it's true vandalism, it can be considered vandalism, you want to be covered for that. Because the point of investing in a real estate is to not be that, you don't want the money pit happening. So know that tenants aren't going to treat the property as if it's their own.
Right.
It just, very rarely it happens. And then you want to have a clause in your landlord policy
Yeah.
to cover missed rents.
Here's the addendum. So 2 things. if it's somebody you rent to, vandalism isn't covered. Secondarily, vandalism doesn't always come with a landlord's policy. It's some theft and vandalism has to be endorsed. However, here's your protection. Regardless of whether you think you're a big landlord or not, or you need all these, require them to have a renter's policy, okay?
It doesn't stop them from taking the
And-
washer and dryer
right.
out when they move out in the middle of the night.
But list that, but here's the reason why you would do that. And list you as an additional insured. So for example, if he writes a mortgage, I write the homeowner's policy.
The renter's policy?
Yeah, so when I write a homeowner's policy for a new purchase, he gets listed. So if somewhere down the line the insured cancels my policy, he gets a notification. You being listed as an additional insured, if they cancel that policy, which frequently happens, you get something in the mail and says, hey, your tenant canceled the renter's policy. Now here's the reason why.
Just hold on to that.
Not for that, but let's say there's a grease fire. Totally accident, negligent. Do you want to put the claim against your landlord's policy, or would you like to sue the liability that's in the renter's policy to fix the damage that they occurred? It's insulating your policy from you having to take it. Yes, they'll have personal property coverage, which is great for them. So if their stuff gets lost, if you had a water loss in that home, it covers that because their stuff's not covered. But it's protecting your policy. If you were so inclined to allow them to have an animal, a dog, you got to require it. I have a situation, personal friend. A dog was attacking a girl. He was coming out of the gym. He jumped in and he took it. He got the dog off the girl. He was bit up pretty bad. The owner of the dog, 24-year-old, in a rental property, didn't have renter's insurance. The landlord got sued because he allowed the dog in his property. The liability follows the property. So that's why you want to, especially if anything with an animal, you want to make sure that you're doing that.
I have 3 pit bull service dogs in one of my units.
Okay, well, I mean, service dogs are, but it's just an extra layer of protection.
We learn too.
We talked about Section 8 properties. What kind of insurance do you need to have for a Section 8 property?
Same.
Yeah. I'm not writing it any differently. Whether it's Section 8 or that doesn't matter to me how I'm writing it.
And
You know.
typically, Section 8 client, like the voucher clients, a lot of times, they'll say like, I don't have the money for insurance. It's about $150 a year.
Yeah, it's running. It might run
So
you
if
10
they don't
bucks.
have the money to
Yeah, it's $10-15 a year.
protect
or
you.
$10-15 a month.
Somebody's,
Yeah.
they have that $150.
Yeah. Even if they got if they have $10,000 in contents coverage, and then the liability, which is you are most concerned about in any of your major apartment
Sad,
complexes,
they have big
it's
TVs that
required.
they need to cover.
Yeah, you can't get in without renter's insurance. So,
Good
Yes.
information.
Okay, for a first-time home buyer, the grants, are they offered through the lender?
Several different ways to acquire grants. You have the First Front Door program that very few banks have. So Dave, if that's an option,
What's it called again?
First Front Door.
Thank you.
Now, there is no time restriction of how long you have to be in a property. So that $5,000 free money, it's really free, is great. And then you have the county programs. You have township-based programs. So those grants, 9 out of 10 times with the Montgomery County, it's up to $10,000. You can use it for your inspections, your closing costs. You have to stay in your house for 15 years. And that's a very long commitment to use that $10,000. Life is going to change within that 15 years. And basically you have to pay that money back. Now, if you go to sell your house, let's say you're in the house for 5 years and you're selling it and you don't have any proceeds, then they don't come after you. It's not a deficiency of judgment at that point. The grant just goes away. They eat it. But if you're in that house and you're going to try to make some money by selling that house, county's going to take their money back first
From the proceeds of the sale.
from the proceeds of the sale.
So you were trying out about the first,
First Front Door is probably my favorite grant program that sits on the street today.
okay.
And you can combine that with other grant programs that Carolyn mentioned. PHFA has not necessarily a grant program, but they have a closing cost advantage loan that you can take. It's a lesser of $6,000 or 4% of the purchase price, 0% interest paid back over 10 years. So if you buy a $150,000 house, you could get $6,000 to use towards down payment or closing costs, and you're paying back $50 a month, no interest.
And which one was that?
Pennsylvania,
PHA.
PHFA, Pennsylvania Housing Finance Agency. They have a booth out there too, Barb Stevens. I'd recommend you go talk to her because she's a wealth of knowledge. Track her down.
And they're on our website as well.
Yes.
So
Yeah, and for when you leave here today, we encourage you to go to www.MCPHO.org. And if you want to know, you've probably talked to a lot of people out there, you want to know who's really involved and makes this their part of their life's work. Barb is on our board, and Barb is full of knowledge. And you do want to find her. But everybody that's on there, they also have links. So if you just go to us, you'll find the PHFA link too.
All right, one more time for that website.
www. Everybody write it down.
Oh, you don't need to
Take it down.
www.
No.
yeah, come on.
I do. I'm old school. Come on. And then
World Wide Web.
MC. You did that on our last video. MCPHO.org. Montgomery County Partners for Home Ownership.
And as we're doing here today, videos from previous years for classes that we did not record, they're on our YouTube page, MCPHO. Look it up on YouTube. You'll see those classes
They're
come right
linked
up.
to our website too, right?
They might be linked. Yeah, I'm pretty sure. Yeah, since I'm not the one linking them, but I know they're on YouTube because I put them there.
Pretty sure they're linked.
They might
I've been
be.
telling everybody
Pretty sure
to
they
go
are.
there all day.
So,
Any other
Other
questions?
questions? Anything you want to know about buying a house?
we're gonna give
buying
away
investment
money, so-
property? Yeah, we probably have to. Somebody's going to win $500 soon. So
Gifts,
gifts.
are they only restricted from family? Can it be
Okay.
from a friend?
Gift, here's the definition of a gift. Okay, a gift is defined as a gift that does not require repayment, and it can be from an immediate family member, which HUD defines as mother, father, sister, brother, foster mother, grandfather, grandmother, sister-in-law, brother-in-law, aunt, uncle, niece, nephew, but believe it or not, cousin, they don't consider a blood relative. Now, if it's a closely established relationship, like a fiance, for example, that's acceptable. If it's a lifelong friend or a long-term friendship that you've had with somebody. So it's broadly defined.
But not a cousin.
For what? Listen, I went through the new handbook. I said, listen, you got every delineation possible, and you're telling me cousin is not, but you can actually do cousins now if you establish the relationship. So if you get a letter from the donor saying that I'm going to give $5,000 towards my cousin Karen, and we have known each other for 15 years, and Karen's mother and my father are, however, related, that's
Just
acceptable
tell a
there.
story. Just
Yeah.
tell a story.
go on to Ancestry.com, print out the tree.
No, it's,
Don't do that. Just
It's
go, make it as you go.
You're good.
yeah. So, yeah. They loosely define family members there's a lot of different family members.
So no BFFs.
BFFs are good. As long as the BFF ain't good.
There you go. All right, there you go.
Thank you so much
Thanks
for your
again.
time.
Thanks for coming out.
Thank you.
Appreciate it.